Manishi Chaudhary from BNP Paribas as well joins you on board. Hi Manishi, how are you feeling about the market? And now in retrospect, does it look like Monday's euphoria was perhaps a little far-stretched?
Well, I think there was a lot of political hope that got built in over the last couple of days of previous week and obviously on Monday. But at the same time, I think domestically the market is beginning to understand that the state assembly election results don't necessarily lead to a very similar outcome at the general election level. And secondly, it's also premature. There's almost about 5 to 6 months left before the bigger political event. And therefore, at the present point of time, it's the global events that are taking precedence over the domestic events, which were discounted by the market over the last few days.
Manishi, so how should one invest in this kind of a market? Because markets surely are building in some degree of hope. Hope trade is clearly there in industrial, cyclicals, and even capital goods stocks now.
All right. Absolutely. And, I think in the medium term, it is actually difficult for the investment cycle to recommence just right now. For that investment cycle to recommence, we need several things. We need the infrastructure companies to solve their over-leverage problems on their balance sheet. We also need corporate confidence to come back quite significantly, and that is where the linkage with politics comes in. But to figure out the final outcome, we have to wait about 5 or 6 months. And, of course, we need to get around several administrative hurdles, environmental and otherwise, so that several clearances are given out for many of these projects. So, in the absence of a significant revival in the investment cycle, I would not really recommend chasing this rally in the capital goods and infrastructure stocks, particularly in the second-tier infrastructure names which are still saddled with significant degree of leverage on their balance sheets. Instead, if you look at India and recall that usual familiar economist's equation that GDP is C plus I plus G plus X minus M, then there are 2 out of those 4 components that are working in India right now. The first is X minus M, net exports. That's clearly reviving as a consequence of the currency depreciation. The second part is C, and particularly one part of private consumption, which is rural consumption. Therefore, investing in India also has to be centered around these 2 big themes. And therefore, we are currently overweight IT services, pharmaceuticals, the merchandise exporters and autos, likes of Tata Motors or Bajaj, and the other rural consumption plays like Mahindra & Mahindra or ITC, just to name a few. So there you have a core set of stocks, maybe about 7, 8 or 10 stocks, which could also be kind of capped up with some investments in the private sector banks, particularly those which have a strong liability franchise like HDFC Bank or ICICI Bank. So, we're not really deviating from that core set of stocks, which are relatively safe. And, while one could look at some of the bigger engineering companies like L&T or so, but I think the recent rally in some of those have been just too sharp, and an investor might want to wait for some correction there.
How does one now approach the banking pack, Manishi? Because it's getting pretty tricky with the market moving up one day, down one day, and the banking pack clearly leading the force.
Yeah. All right. You see, what has really participated in last couple of months is the public sector banks, because they were cheap. And on top of that, in the last result season, some of the PSU banks actually came up and said that their asset quality problems were behind them. However, we don't subscribe to that point of view yet. We think that the asset quality problems of PSU banks, there is still some way to go before they get properly solved. And, one reason behind this is that some of those infrastructure projects are possibly getting commissioned over the next couple of quarters. So therefore, the loans would become repayable and the interests would become payable after these projects get commissioned, and that would be the true test of asset quality as far as the PSU banks are concerned. So in the banking space, we are still sticking to the private sector banks, and particularly those which have a strong deposit franchise, or in other words, a very large CASA ratio. And that really brings us to possibly the top three, the likes of, HDFC Bank or ICICI Bank or Axis Bank, even though the asset quality is slightly weaker there compared to the first two that I talked about. And among the mid-cap banks, possibly IndusInd Bank could be an approximation to that universe. So we are being very selective in the banking space, looking predominantly at the private sector banks.
Manish, if the core concerns for the market are not over, which is earning, high inflation, contraction in margins,
Right.
Why is the technical picture of this market so strong? Markets are no longer polarized. Benchmark indices are not far away from an all-time high, and with each passing day, more and more stocks are participating.
Reasons are both global and local. If you look at whole of Asia or the entire emerging market universe, this rally actually started sometime in mid to late September. And that coincided with the postponement of that tapering concern. When in September that widespread expectation of beginning of tapering didn't materialize. So that's when global equities, or in particular emerging market equities, started moving up. India also participated, and not only did India participate, India actually outperformed quite significantly. Because what was happening in India was, there were two or three other things, and that's where we come to the domestic news flow. Two or three other things were happening. Number one, the macroeconomic data points got slightly better. After, a run rate of about 17 to 20 billion on the trade deficit side, it came down to about 7 to 10 billion for about 4 months in succession, which culminated in a current account deficit of hardly about 5 to 5.5 billion, which now seems that the current account deficit for the full year would be less than 50 billion, which is quite comfortable for a country like India. So that's point number one. Second, the quarterly result season, which went by in the month of October and November, that turned out to be slightly better than expected, particularly the first half of the season, where the private sector banks, the IT companies, and some of the larger engineering companies reported better than expected numbers. And third, this political hope that started getting built in from somewhere around mid to late September and culminated with the state election results a couple of days back. So these were the three factors that led to the outperformance of India, and naturally when these things happen, actually the domestic cyclicals, the public sector banks, the engineering companies, infrastructure companies, they tend to participate a lot more, which is what we have exactly seen. But now, I think we are entering the consolidation phase. The markets are beginning to understand that those fundamental problems that you just talked about, sticky inflation and therefore the concern and the risk on earnings estimates, those are actually likely to materialize over the next couple of quarters. So I think we will be in this consolidation phase for some time now.
So are likely to consolidate for next 2 or 3 months. What are the best options to make money? Because ultimately what traders want is direction, and what investors want is stock ideas.
Yeah. If we do have a consolidation phase, the market correcting somewhere around 5 to 7%, even though the lower limit of the market's trading range may have got elevated somewhat, I would think that in such a scenario, the high beta stocks which have participated recently would possibly underperform. Therefore, in the very near term, I would stay away from the public sector banks. I would stay away from the infrastructure names, particularly the second-tier infrastructure companies with high leverage. And I would look more at the so-called defensives, even though I kind of hesitate to use that term. I would rather call them the exporters and the foreign currency earners, like in IT and pharma. Also, the rural consumption plays like two-wheelers, tractors, and very select consumer staples companies like ITC. Though, on the overall consumer staples space, particularly on the home and personal care product segment, the likes of Hindustan Unilever, we are quite cautious. Not just because they are expensive in valuation terms, but also because they are big consumers and importers of soft commodities, whose prices have increased tremendously just in dollar terms, and therefore more so in rupee terms. And therefore, it would be difficult for those consumer staples companies to pass on those input cost increases to the consumer. So that's another area where we anticipate earnings estimate downgrades.
Manishi, how would you approach names like NTPC and Power Grid, which cracked pretty hard yesterday post the CERC guidelines? Would opportunities like yesterday be opportunities to start buying into the stock? Perhaps that's what explains the green tick on NTPC this morning.
After that, very significant downtick yesterday, I think NTPC was down more than 10%, somewhat close to 11% yesterday. We think they're actually looking reasonably attractive at the current levels, because on our estimates, even in the worst case, the downside to NTPC's earnings could be somewhat around 7%. And we don't think that all those elements of the CERC guideline would be exactly implemented in letter. And as a consequence, the actual downside to earnings could turn out to be significantly lower than what we estimated. And as a consequence, after that 11% decline in the stock price, the stock does look attractive at these levels. In general, we like the regulated utility space, particularly stocks like NTPC, where you have certain degree of visibility about their new capacities coming up. In fact, we don't really like the merchant power space. In fact, we prefer the regulated utility space. So I think after this downtick, they are looking reasonably better compared to the previous price history.
Manishi, we are less than a little over 1 quarter away from that gas price rejig. Come April 2014, gas prices in India will move up. That is a big jackpot for Reliance. So if the future is so bright for Reliance, why is Reliance massively underperforming markets?
Well, I think it has improved slightly of late, because the reason for underperformance is more fundamental in nature. I think the market is quite cautious on the basic variables that govern Reliance, like petrochemical prices and refining margins. And if you have a situation where oil prices are likely to remain benign or likely to trend down, in such a situation, usually the refining margins also don't really move up significantly. Having said that, our house view is slightly different on this. We think that refining margins are likely to stabilize and possibly improve. Not a very sharp improvement, but a gradual improvement in 2014. So, we are not really as bearish on Reliance as the recent market trend suggests.